Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about how you can get 5% CDs, the importance of the inverted yield curve, and the potential buyout of Activision by Microsoft. But before we begin, as a reminder, this is financial education presentation should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. This morning's inflation number showed an increase in inflation, and the markets are in the red. Are there safe options out there while the market is still volatile?
Hey, good morning, everybody, and good morning, Allison. So, yes, there are. That's the good news. The bad news is the market is volatile. Like Allison said, you can see the futures are in the red here. The Nasdaq's down over a point. So is the S&P. And why is this? Well, we got another inflation report this morning. So we had one yesterday, and I said the markets would be in the red, and the markets kind of laughed it off. Honestly, we went from deep in the red all the way back to green by the end of the day. Today, I don't see that happening. This again, 2 days, two hot inflation numbers. So, that means, and you can see the kind of the headlines there is, more rate hikes to come, right? They're saying Meister supported a 50 basis point rate hike. We thought maybe that the Fed would pause now and call it good and start engineering that soft landing. Now the projections show, at least before this number, that there would be a a 25 basis point raise at the next meeting and a 25 basis point after that. Now we'll have to see. Now we may have a few more raises along the way. But how that relates to you is that means CDs are paying 5% plus, right? So really to get 5% on a, that's your option, right? So if you have money on the sideline, or if you want to move money out of equities, which I generally don't recommend because you kind of want to ride through. But you know what? If you need to adjust risk, adjust risk. But certainly for money that's sitting in the bank getting inflated away, you can get 5% on a 1-year CD. So why 1 year? Well, it's the best you're going to get as far as the percentage points, and we'll show you that here in a second. But 1 year is enough time to lock that money away, get the 5%, and then reassess where everything is in a year. We should be through all the rate hikes, obviously before that, but we don't know. No crystal ball, right? We should be done with all of that. Inflation should be well under control a year from now. So that's why people think it's a good idea. If you're looking for a nice risk-free investment, CDs, if you go to your bank, you won't be able to get quite as much as you will if you go through a brokerage like Schwab, which is what I use, that has better deals with the banks where you can get the premium return there. But yeah, you buy a CD basically. You hold it for a year if that's your holding period. They're also 15 months or 9 months, 6 months. You can get them really any duration. But once you get it, you hold it and you get your money, you get to interest and you get your money back at the end. So not a bad option for those that don't want any part of the volatility that's out there.
Next, the inverted yield curve is a primary indicator of a coming recession. Can you show us the curve and give us your thoughts?
All right, here's the curve, and literally this is your like Econ 401 class, and Allison, you're a freshman, and I will tell you, even if you major in economics, you could spend 4 years honestly talking about this chart, and that's how difficult it is to understand. Simple in theory, but complex in execution. So we're going to talk about it for just a second here. When Allison mentioned it's a primary indicator of recession. Well, it's also it over indicates recession, right? So you've heard me probably say before that this chart has predicted 30 of the past 10 recessions. So the joke there meaning that when there's a recession, the yield curve has always been inverted. So in that part, it's true. But just because the yield curve inverts doesn't mean there's a recession. So there's not there's an indicator value there, but it's not causal, if you will. So what are we looking at? Well, this is yesterday's chart. So if we have today's chart available, we do. Nope, it's not available. It kicked right back to yesterday's. So this is treasuryyieldcurve.com. This is right from the treasury.gov website. You click on it and you can see the curve. So the bottom here is not zero. The bottom is 3.8. So there's a zero before that. Below that, right? So when you look at this, you start with, and this is time across the bottom. So you have 1 month all the way, just trying to get rid of that box. It's no, not going to happen. Get rid of that box. Oh, there we go. So you have 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 5 year, 7, 10, 20, and 30 time across the bottom. So what is this telling us? Well, if you go out to the peak of this chart, it's between six months and 1 year. And then when you hover over that dot, it tells you that the interest rate is 4.97 at 6 months and 4.96 at 1 year. So when you think of normal like CDs, which are pegged to this thing, that's why I just talked about the 5% CDs are now available. If you're willing to lock your money away from 6 months to a year, you can take advantage of that 5%. However, some people some folks are like, well, that's great, but I want to lock in that 5% for 10 years. You can't do that. If you want to lock your money away up for 5 years, I think I said 10 initially, but 5 years, you're only going to get 4% a year. So that's the trade-off of if you're looking for risk-free return, which again is treasuries and CDs. If you want to try to get more, you're going to get a less interest rate. It doesn't make sense, right? And that's because that's the yield curve's inverted. If it were a normal yield curve, the further out you would lock up your money, you would get paid more for it. So the curve from the left to the right of the chart would be, increasing the whole time, but it's not, right? So a couple more scenarios and we'll talk why. If you want to lock your money up for 10 years, you're only going to get 3.81%. So for those that I've put in some longer term CDs, I've accepted that. It's the 3.81 might be bad now. You're like, well, Steve, why would I want to be in that if I could get 5? Well, you would want to be in it because you can guarantee yourself that money for that long term, and interest rates in the future may be a lot lower. And if they're below 3.8, you will have been a genius by locking your money up that way. And that's my bet for the folks that I put in the longer term. You can see there's a little bump out here from 10 to 20. That doesn't really make any sense. But when you look at this chart, the important part is this short term, this 6 months to 1 year. That's what the Fed is influencing. When they raise short-term interest rates, that's what they're raising. So if you will, you would take like a normal chart, you're taking like a tent post, if you will, and artificially pushing up the 6 month to a year rate every time they raise rates. But the rest of the chart is voted on by the market. So what this chart says to you is that the Fed says interest rates should be at 5%. And they're going to stay there. And this chart laughs that off. It's like, okay, I hear you, and we can do 5% right now because that's what you're setting the rate at. But honestly, 2 years from now, we don't think it's going to be that high, and certainly not 3 years from now, and definitely not 5 years from now, or 7 years, or come on, 10, 20, 30 years from now, are we going to be at 5%? The market is saying, no way, absolutely not. The rates are going to start coming down probably around the 2 year point or maybe the 3 year point, somewhere in there. So that's why the market is completely disagreeing with the Fed. So why would the market disagree with the Fed? And that's because the market thinks that the Fed raising rates is going to cause a recession. By raising rates, money becomes more expensive and it's going to slow the economy down, which will reduce inflation. True. Well, it should, right? It's not one for one, but it should reduce inflation. In the course of doing that, it's going to slow the economy to where maybe we have 2 consecutive quarters of negative GDP growth, the commonly accepted, definition of a recession. So that's why this yield curve is out here. It's inverted. It's not continuing up and to the right over time, which it should. So, very interesting. You could talk about this literally for days on end, this one chart. But that's why it's so important to everybody. But that's what the Fed is right here at this 1 year point, taking their tent post and pushing that rate up. And it affects the long-term rates, but the market gets a vote, and the market saying absolutely not. So that's probably enough for one day. If you do, the important part is if you want to lock your money up for a year and get out and reduce volatility, move it into a CD. You're getting 5%. Should we wait 6 weeks for it to go to 5.25, I would say no. You want to start making money now versus trying to eke out that extra point or quarter point, right? So all the big moves have been behind us. That 4 in a row, 75 basis point move, that's all behind us. So take advantage of the opportunity for, get 5% for a year and then assess from there.
Last, Microsoft has agreed to buy Activision in June of this year for $95 a share. Why is ticker ATVI below that? Wouldn't this be arbitrage situation?
Well, sure. So basic arbitrage, right, is if somebody's buying something at this price and somebody else is selling at a price lower than that, the arbitrageur, the person in between, would say, okay, well, if somebody's going to buy these from me for $95 and I can buy them for 90, I would buy all I can at 90, hold until this buyer bought them at 95. There's a $5 arbitrage there. And you would do that for one share or as many shares as you could actually get, right? That's a basic arbitrage situation. When you think of if you're on social media and all these people talking about buying stuff on the cheap from either consignment stores or Costco and then turn around and then selling them online at a higher price, that is basic arbitrage. If a tube of toothpaste, if you can buy a whole bunch of them at Costco and it costs you $2 and you can sell them online for $2.50, then you make 50 cents per tube of toothpaste. Period. Dot. Right? As long as the market supports it. Well, why I bring that up is that's what arbitrage is. Now, in this situation, you look at the date on this article is January 18th of 2022, which is right here. So over a year ago, Microsoft agreed to buy Activision at $95 a share. That's why I use that 95 reference. So at $95 a share, Microsoft is going to roll in and buy Activision. Now, $68 billion all cash deal. These things get scrutiny, right, from U.S. and other governments that take a look at this. And it's just like, well, not all of them get approved. If this was a for sure thing, then obviously ticker ATVI, which is at, we'll pull up the actual stock price here. That just shows the change. The ticker's not, the stock is not selling at 95. It's selling at 77.45. So what's the difference, right? And we'll pull up a 1-year chart. Actually, might even need a 5-year, because when the stock gets that deal, it jumped up, if you will, to 81, but it didn't go all the way to 95. And there people are like, well, why not? Why wouldn't I buy all I could get my hands on here at 77 if I know Microsoft in June of this year is going to pay me $95 a share? Because you don't know that. And actually, there are several articles out there that are saying the deal may not go through. Whether it's and this what this headline says is from this morning, that the stock can rally regardless of the Microsoft deal. Meaning, even if the question becomes is like, okay, the deal may go through, and then we all know we get 95 a share. That's a clear buy signal. But what would the stock price be if the deal fails? Now is the stock higher than it should be or lower than it should be? Obviously, Deutsche Bank chimes in on its opinion here, but looking at that chart, I don't know that it is. Microsoft was willing to pay 95. If that gets approved, great. The stock jumps up. Well, the stock actually goes away at that point. But if you were to buy it here and that doesn't go through, you're going to be holding Activision Blizzard as its own company, and you don't know if it's priced correctly or not. So there are funds that are arbitrage funds, that are merger funds that try to capitalize on these situations left and right. And, they don't exactly print money because of the real world. This thing may not actually go through. And if it doesn't go through, I would expect the stock to crater, to be honest. As soon that day that it's announced, which we don't know when that is, right? Whatever day that is, if they say, hey, the deal is off the table, it's not going through, then the stock, instead of being at 70 something right now, could drop down into the 60s. So that's the risk you're taking if you get in on something like this. But overall, that's the basic of arbitrage, and that's what's going on with Activision and Microsoft.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.